I'm Evelyn Uwogu. I'm a finance professional, about 13 years experience within the financial services space. I work with ARM investment managers as a financial controller. Okay, I really wasn't looking to delve into financial modeling, but I was privileged to attend the DAMC event earlier in the year, that's Data Analyst Modeling Conference. And I got to speak with David Brown, and um, he introduced the Financial Modeling Academy to me. And one thing that really caught my attention was the deep discount was coming at. It was coming at a very affordable rate. So I was like, why not? Plus, I had had other trainings with D Brown, and my expectation was really high. So I felt, why not give it a try? So I jumped online and joined the cohorts, the early cohorts, writing the exam. And trust me, no regrets. It was good value for money. So yes, I'm a finance professional with finance background, but we had people from different spheres within the cohort, and everybody, to a very large extent, was able to keep up. I feel like the academy there was value, double value. One, you're able to brush up your skills as a finance professional. Even if you didn't have any finance background, you get to have some bit of finance experience plus the financial modeling skill. It was a very great experience. The journey was smooth. The D Brown Academy, D Brown Consulting gave all necessary resources and support needed for one to succeed along this financial modeling journey. The sessions were very interactive, or let me say the videos were very interactive and properly structured. It was delivered flawlessly. And then we had weekly live mentor sessions where we had interactions with David Brown and the rest of the cohort. And then we got to see different perspectives to different things. So you never attend a live session and leave without value being added to you. So the whole journey was very expository, very insightful, and we were prepared 100% for the exam by the time we were ready to go.
All right. Good morning, good afternoon, good evening, everybody, and welcome to another webinar by D Brown Consulting. So today we're going to be talking about modeling with integrity, ethical standards for financial professionals, or should I say finance professionals. Right, so I'm connecting with you from Abuja. Just finished the ICANN conference. You can see I'm already in a hotel. Yes, just concluded the ICANN conference. Who is here from the ICANN conference? ICANN, for those that don't know, is the the Institute of Chartered Accountants of Nigeria. Type in the chat if you attended that conference. Type in the chat, say hello. Let me know if you're here in Abuja, the capital of Nigeria, with me. And just let me know where you're connecting from. Let me know your name, where you're connecting from, where in the world you're connecting from. Just type in the chat. Okay, while we're doing that, we're going to jump right in. Yes, what exactly is integrity? And when we're talking about ethics, what is ethics? I mean, is there ethics in modeling? Yeah, well, we're going to discuss that in more detail. All right, let me see if things are coming up. Okay. All right, so I'll wait for that, but let us jump in. Let's jump in. So, modeling with ethical standards in mind, right? What do we mean by that? But let me quickly introduce one or two things first before going there. How do I approach things? I like to think systems-wise. I think most of everything we do is already done, right? So we have to think in systems. So I collaborate with a lot of people, best practices, to try and understand best practice. And we at D Brown Consulting, we collaborate a lot with anybody that has those best practices. We want to know them, we want to connect with them, we want to collaborate with them. And I'm biased in the sense that when it comes to data, I think you can use Excel to build anything with data. I think Excel is one of those Swiss Army knives. The Swiss Army knife tool, you can build anything with Excel. You can model some frame. We can do a whole bunch of apps and stuff. You can build it in Excel and test it out and see if it works. And then you can then call your developers to kind of scale that. Or you can scale it yourself by working with good AI to build out your whole solution, but you will still need a senior developer to kind of check through things. But with artificial intelligence now, we can build all sorts, right? Interesting. All right, so that's me. What's my goal? Show you how to shift from merely meeting compliance requirements when building financial models to leveraging ethical modeling principles to speed up the transition from data to trustworthy insights to save your firm loads of reputational risk, save your firm from reputational risk, right? And any costly errors that could happen. I'm going to talk about some costly errors that people have had in the recent times, especially when they decide not to do thorough reviews. And they think, okay, do you know what? Let's get AI to do those reviews. AI does a good job sometimes, but AI lies sometimes, and that can cost you a lot of money. And it's costing some people quite a lot of money already. We'll talk about that as we go along. So I'm David Brown, the managing partner with D. Brown Consulting. I'm also a Microsoft MVP on Excel and Copilot, which is AI for Microsoft. I'm also the CEO of D. Brown Analytics Solutions. I also work as a consultant with the World Bank. I consult with the Nigerian Governors Forum. I'm a deputy president of the Learning and Development Network International. So I have my learning hat. I'm an instructional designer, master instructional designer, master trainer for the ATD, Association for Talent Development. I'm also the chairman of the ICANN Data and IT faculty. So I have all these different things. So I hope I'm having people from every single branch of what I do. So I kind of do quite a bit. I do a lot of data analytics reporting. That's a niche I really like. And then, of course, financial modeling, building all sorts of financial models, right? So financial modeling, and I have a big passion for that. And we're going to talk about financial modeling a bit later, because when it comes to what we're talking about today, everything can be tied back to a model, right? So you're forecasting, you're advising people on numbers. There needs to be a model backing it. And let me even say, if there is no model backing it, that's part of the unethical way. So you're unethically advising a client to do something and there's nothing backing it. That's even worse. And then we'll talk about unethical things with the model itself. All right. So what have I done? We built over 30 courses, trained over 50,000 students, at least 100 solutions for clients. I'm sure there's a lot more, and almost heading to about 30 years experience in this field. Right. What I would like you to do is turn off distractions. I know some of you probably will be watching the replay as well. It's good you focus on the session. If you have questions, ask your questions immediately. I'll see them pop up. Typically, they will take probably a few seconds for me to see them. Once they pop up, I'll answer them. So if you have questions, type them into whatever platform you're currently connecting to. You're connecting either through Instagram, through YouTube, or you're connecting through LinkedIn. LinkedIn is the core connection. Please type your questions in and I will answer them. All right. Okay. So where are we and what are we doing? What's in our agenda? Okay, let's have a look. So let me understand who is in the room first. Just really want to understand who is in the room. So if this is you, I'm going to give you 3 kind of personas or 3 reasons for you to join this session. Reason 1, reason 2, reason 3. So reason 1 is you have 10 years experience, but suspect you still struggle with compliance and upholding ethical standards with your analysis and reporting. So let's say you have 10 years experience, but you know there's still something to learn, right? So this is the experienced person that wants to pick 1 or 2 things. Then you have mid-experience, that's below 10 years, right? But you're eager to learn the hacks of modeling for analyzing and minimizing risk in your financial models. Is this you? So mid-tier, so you have a very experienced person, mid-tier experienced person, and you're just starting out. You're just starting out in your career, so no big mistakes yet, right? So who are you? Are you 1, 2, or 3? Very experienced, 1, 10 years plus, mid-experience, or you're starting out. 1, 2, 3. I want you to type in the chat or type whatever platform you have. Let me know who is in the room. Are you 1, fully very experienced, wanted to learn a few things? 2, not as much experience, but also wanted to learn stuff? Or 3, well, you're just starting out, new into the workforce, probably not even in finance, you're trying to move into finance. Who is in the room? So I'll pause a bit and see who is in the room. I'll come back to that. And really, if whoever you're in the room, whatever motivations you have, I will over them. It'll be nice to know who's in the room. So whatever your motivations, I'm fully ready for you. All right. Later on, when I finish talking about the deeper ethical issues around modeling, I will go into talking about the academy. Academy, just one academy that you need to be able to be very proficient in these fields. Right. Some of this stuff I'm talking about today are not really stuff you see online a lot. So I'm going to change how I'm going to do this. I'm going to kind of use Excel. You know, I like Excel a lot. Yes, I'm very biased, I know. Yes, so I'm going to use Excel. We're going to kind of break down things using Excel as to what, when it comes to modeling and modeling with integrity, ethical standards for finance professionals. What are we talking about, right? What are the core things that we need to cover? Right. So when it comes to models, right? When it comes to models, let me show you a model. For those that don't know what a financial model is, let me show you. Let me see, what model should I show? Let me show you our typical AFM model that we do for our clients. Well, let me show you. I have so many models here. I'm spoiled. So this is the typical model that we do in our financial modeling academy. So when you do our academy over 8 weeks, you should be able to build a model to this standard, this specific standard. So what's a model? A model basically is trying to forecast financials, trying to give you use financials to basically help you make data-driven decisions with numbers, right? So it's just a model is whatever helps you make data-driven decisions with financial numbers, right? That's a model. And anything that has financials in it, you could say is a financial model. But typically, the standard financial model is a 3-statement model. That's like the starting point for financial modeling, 3-statement models, where you have the outputs of the financials are your profit or loss account, your balance sheet, or your cash flow. That's why it's called 3-statement modeling, right? And those are the key 3 statements that you need to model, right? So once you learn the 3-statement modeling, that's your foundation, and then you can add other things to it as depending on what financial advice you want to give out or what financial decision you need to make, right? Your model should be able to help you answer those questions. Now, some models can be super complex. I have a model that has probably 100 million changing variables. So I'm going to say more than 100 million changing variables in the single model. Super complex. Now, as the complexity adds on, guess what happens? The risk goes higher and the risk of you making mistakes. Now, when you have a risk of making mistakes, it means that your client or yourself, you're making financial decisions on something that is erroneous, something that has an error. That's already a risk. You've advised the client and said, maybe the client wants to do a major investment. You did your model, everything, and the model says that, oh, return on equity is going to be 17%, kind of on the mid-range of 17%. And yet there was one major assumption you forgot. And if you are putting that assumption, return on equity will be 12%, right? And the client's kind of hurdle rate, or the client thinks that anything that gives me a return higher than 15%, I'm good. I'm going to go into this project. So based on your analysis, based on your reviews, they go into the project. And of course, they see that what you did was not right. Now, who gets the blame for that? Who pays for this massive $100 million investment that they've done based on numbers that didn't add up? So I'm asking consultants in the room, right? Now, if you read the fine print for consultants, right, they will say, look, we've done our best work and we require you to do a thorough review of our work and validate it for your use. Or some protection. They're protecting themselves from litigation, right? But this could be a silly error that someone should have seen, right? And they're paying you quite a lot of money. So who takes that risk? Is it ethical for you to say, look, it's not my responsibility. You were supposed to review, you didn't review, but did you have a reasonable basis for that assumption that you had? So that's our first thing I'm going to write. Do you have a reasonable basis? So when we're looking at ethics, so I said, do you have a reasonable, that's my spelling. Do you have a reasonable, terrible, how am I spelling reasonable? Reasonable basis. Do you have a reasonable basis for your assumption, right? So your assumption was be grounded. You must ground every projection in verifiable data, right? Yeah, you must use sound logic. Yeah, they must be transparent assumptions. You have to have things have to be transparent, right? Now, one thing I'm going to do, okay, got this AI tool. By the way, guys, if you have the latest Excel, every time you click this AI, it's kind of annoying. It's Copilot is nice, but I don't need you. Hide. So you want to chat with Copilot? No, I don't need to chat every time with Copilot. Right. Okay. So let me put this. I like editing as I work. All right. I don't know about you, but I like doing that. So headings. This is heading 1. I'm going to kind of copy this heading 1 to the right. To R. That. So I'm building out still. So this is reasonable basis and everything around reasonable basis. Now, while I'm going to go through about 6 with you. 6, how will I call it, ethical. I won't say the ethical standards for forecasting. It's just stuff that I've kind of broken down into categories. But when it comes to us understanding what are the ethics around modeling, I want you to think about synonyms for modeling. Can you type in the chat or your chat? What synonyms to modeling do you have? And there's a reason I'm asking that. You get that soon. So if I'm saying I'm doing a financial model, what's a synonym for it? Right? One synonym is forecasting. Budgeting can be financial modeling. Forecasting can be financial modeling, right? So think about synonyms. Once you think about synonyms, one thing we could do is go to a body of knowledge that already exists. So I'm going to go into CFA Institute, and I'm going to go to their Code of Ethics and Standards of Professional Conduct. So the Code of Ethics and Standards of Professional Conduct for CFA Institute. I'm using CFA Institute because to me, they're the closest to finance. So financial modeling, finance professionals. I think the #1 certification for finance professionals is the CFA Institute, right? CFA Institute certification, which is CF. If you're a CFA charter holder, those are the certifications, right? So I'm going to go to their code of conduct, professional conduct. I go to key documents. So all you do is Google, just Google CFA Institute standards and stuff. You'll see it. So here I'll go to. You can see we have downloads, code of ethics and standards of professional conduct. Read the code of ethics, blah, blah, blah. You have standards of practice, handbook, and you have standards of practice. Well, same thing, right? Standard practice handbook, 12th edition, contains the current version of the code and standards and guidance that support the change. Contains the current version of the code and why do they have it twice? Strange. Okay. Anyone watching from the developer team in CFA? Why is this 2? Just have one of it, right? So I'll download this. If you click on this, I'll download it, but I've already downloaded it. And we're going to use that. I'm going to use a simple technique that I like to use every time. Simple technique for looking through a document. So we're going to use 2 techniques. I'm going to go into this document. You can see it's about 214 pages, quite a lot. So I'm going to go through this document. This is standard of practice. And we're looking for anything related to synonyms for financial modeling. Let's say forecasting, models, and stuff. So let's try with models and see what does the standard have to say about forecasting. And that will give you ideas around when there's an integrity issue, when there's an ethical issue, how do you deal with it? And what does the standard have to say about that? Now, you can use this technique for other professional bodies that are in our field. So you could go to CIMA, for example, Chartered Institute of Management Accountants, go to their own ethical body of knowledge or ethics body of knowledge, do the same thing I'm doing, go to ACCA, go to ICANN, whatever professional body that kind of is related to accounting or finance, you should be able to do what I'm doing here. So let's do a search. Let's do a Control F, and then let's look for models. Models is a good synonym, so I've typed models. I can see 39 entries for models. So let's go step by step. Well, let me go first, the first one. Okay, here we have use of third-party information, right? Use of third-party information. Okay, so that's interesting. So say members and candidates rely on models to identify new investment opportunities, develop investment vehicles, and produce investment recommendations and ratings. Although not every model can test for every factor or outcome, members and candidates must ensure that the analysis incorporates a broad range of assumptions. So this is always, you're going to see this a lot, right? A broad range of assumptions, which means you need a reasonable basis. A broad range of assumptions means you shouldn't just have one assumption. You should have a bunch of assumptions, best case, worst case, likely case. And one of the themes you're going to see throughout our discussion is you need to show a broad range of assumptions. We can't predict the future. We're not God, right? We can't predict the future with certainty. We can only assume. And in your assumptions, don't just have rosy, optimistic assumptions. You need to have a range of assumptions and say, look, this is the range. This is what should happen for this optimistic assumption to take place. This is what could happen for this pessimistic, terrible thing to happen. We need a range of assumptions. All right. So let me go back and let's type a few things here. So what we're saying here, for reasonable basis, we're saying you need to ground. So you basically need to ground every projection. Yeah, you need to ground every projection in verifiable. I have to ask AI to kind of change this spelling for me, right? Verifiable, or fix the spelling. Verifiable data. And then you also need sound logic, right? And then you also need transparent assumptions, right? So this is key. So this is what we mean by reasonable basis, right? Transparent assumptions. So now, going back to my technique, this modeling technique. When you come here, I type a synonym for models. I say models, and you just click it. So let's even click. We have 39 clicks to do. So let's even go through the 39. But then I'll break down all of this into my 6 criteria, right? For modeling with integrity, ethical standards in how we forecast. All right, what's the next one? Omission. So CFA is under the heading of misrepresentation, very important. Under omissions, they say the omission of a fact or outcome can be misleading, especially the use of models and technical analysis processes, right? So if you omit something, it's misleading, right? So there's an omission, it's misleading. Is it deliberate? Because sometimes you could deliberately omit something, right? So that your forecast can be rosy, and you claim ignorance. That's very unethical, highly unethical, right? So definitely that's one, omission. Now, by the way, when you're using this technique to search documents, one thing you could also do is download this document and give it to AI and tell AI to do a thorough analysis of this document and pull out, create an ethical standard around forecasting based on all the entries related to forecasting and financial modeling in this standard. Then you can create a substandard. Maybe we should do that actually. Why not? Okay, probably at the end I'll do that and see if we can create a substandard from there. When you're deciding, another one that will work is projections. Let me see, projections. Projections has 9 entries. So you could go down the entries and search. So this is how you do research. The attribute to their sources by any direct quotation, including projections, table statistics. And let's stick with our models. I'm just showing you techniques. So models, we have 39. We've looked at a couple. Omissions is talking about omissions. Members and candidates may rely on such models and processes to look for new investments and stuff. So obviously omissions is a big thing. If you omit information, it's key. This one is in some situations, however, members or candidates may use research conducted or models developed by others. Let me see what heading this is under. Companies have structured financial models that they use to advise clients. Imagine an equity research analyst or equity or a fund, right? Where people are investing in that fund and then they're advising on what investments to make based on their model. And then they have to then update this model or create a new model. They're basing this new model on the old model. So and who knows, if the old model is not owned by them or is a general model, they need to kind of state that, okay, this model, this version 2 is based on version 1. These are the assumptions. These are the key changes we've made. Just need to be transparent. So yeah, plagiarism is one. Now, one nice thing about the CFA Institute and other bodies, when they give you these ethical standards, they give you examples so that you understand the context. So let me see if there are some plagiarism examples. Look at one here. Plagiarism, example 9. Browning, a quantitative analyst in Double Alpha Inc., is excited after returning from a seminar. In that seminar, Jorali, a well-publicized quantitative analyst at a national brokerage firm, discussed one of his new models in great detail, and Browning is intrigued by the new concept. He proceeds to test the model, making some minor changes but retaining the concepts until he produces some very positive results. Brown, so he's tweaking. It's not illegal. It's not unethical too. You're tweaking your model, tweaking till you get the results you want, right? As long as those tweaks make sense. That's by the side. Anyway, Browning quickly announces to his supervisors at Double Alpha that he has discovered a new model. Did you really discover a new model? Remember, he got the model from somebody. He did some small tweaks anyway, and that clients and prospective clients should be informed of his positive findings as ongoing proof of Double Alpha's continuing innovation and ability to add value. So comment. Although Browning tested Jorali's model on his own and even slightly modified it, he must still acknowledge the original source of the idea. Browning can certainly take credit for the final practical results. He can also support his conclusions with his own test. The credit for the innovative thinking, however, must be given to who? The original person that originated the idea. One thing I like to do is originate ideas around models, right? So I have a particular problem, I'll originate an idea and say, okay, this is what I'm going to use to solve this problem. Build it, test it. Does it make sense? Do backward testing for it. You already know what happened last year. So build a model based on assumptions that will then predict last year and see how well it predicts it, right? So that's you building your model. So what Browning was doing is he was doing all those tests and stuff, but the original concept of the model is not his. He needs to acknowledge. So he shouldn't misrepresent. He needs to acknowledge, right? So I'm going to call this no misrepresentation, right? You're not misrepresenting your work. So I'll do the second one. The second one, let me just put this. I'm going to copy this, Control C, paste. And this will be no misrepresentation. All right. So no misrepresentation. And what do I mean here? So apart from that simple solution on plagiarism, you need to avoid bias. You need to not cherry pick. So cherry picking, you change a few things, he's tweaking to see if the model gets him a nice answer and says, oh, this model is now giving me an excellent answer after tweaking. Are those realistic? So you need to avoid bias. You need to not cherry pick. You need to be able to, if you're guessing, you're not too sure of certain assumptions, you need to state it there that, look, these assumptions, there's not much research out there. I've created multiple assumptions here so that I don't misrepresent, right? Because you need to understand that we are all biased human beings, so we come with our biases, right? So then you can present a full picture once you have all this disclosure to avoid risk, all right? Okay, and yeah, so let me summarize this as you need to avoid bias. Hold on a second. Let me be sure I'm still connected correctly. I think so. Yeah, you can hear me, everybody? Great. Okay, so let's. All right. So you need to avoid. Where are we? You need to avoid bias. You don't cherry pick. Don't cherry pick assumptions. I don't know how to spell cherry pick. I think it's 2 words, cherry pick assumptions, right? Then also do a thorough base case. Let me say, do a thorough base case. Now, when you model, right, just take it that the first thing you're modeling, all the assumptions you have in your model are your base case. That's your base case. That base case should be super thorough. That is like your foundation of your model. So let me show you the model. Let's see, model. Okay, so look at this model here. If I go to the scenario section of the model, right? So this is a scenario section of the model. You can see revenue year-on-year growth rate. You have cost of sales, percentage of sales. You have SG&A as a percentage of sales. I click on this drop down. I say base case. This base case, which is typically the middle case, you need to do. That's where the most work should be, right? Your base case, your first case, your base case. So that's your base foundational case. Now everything after it, it can be either rosy, or pessimistic. So pessimistic, optimistic. You have the middle case. And your middle case, that's where all your research should come in. You know you can defend that middle case. So then you're saying, well, in a situation where the economy does wonderfully well and inflation kind of drops from 14% that I projected to 10%, and we have growth in the economy of 15% growth year on year for the next 5 years, those are your rosy case. But your base case should be the one you're super defending, and then you have rosy. But don't just do base and then plenty rosy cases, and your pessimistic case is not really pessimistic. That's you kind of fudging the numbers, right? You're not representing things right. So do a thorough base case, right? Yeah, so again, do a thorough base case, present the full picture at all times. At all times, okay? Including risks and pessimistic assumptions, and risk and how do I call it? Not so rosy assumptions. Just say including all the risks. Let me just say including the major risks. All right. Okay. All right. So that's under no misrepresentation. Let's go back to our technique of using existing standards to find out what does the finance profession have to say about forecasting, and what risks and unethical behavior do we have there. So continue with this, creating artificial price volatility. Oh, wow, these are lies, right? Artificial price volatility. I guess this is no misrepresentation. It's still the same. Cover that. When you're creating artificial price volatility, you're saying, oh, the volatility is a certain range, and then your client now has to, you're kind of misrepresenting the volatility. And volatility means there's so much volatility, which means there's so much risk. And there could be actually big rewards too, if you get it right. So that's misrepresentation. Same thing. Computer models, no, we don't need that. We have computer models and computer models, spreadsheets and high major towers. Let's go. Quantitative models. Okay, what are we talking about here? What section is this? Investment recommendations and actions. Okay. So investment recommendations and actions. So members and candidates must make reasonable efforts to consider and address all pertinent issues when arriving. I'm looking up because I'm on another screen, so I'm looking up, guys, a different screen. When pertinent issues, when arriving at recommendations, consider and address all pertinent issues when arriving at recommendations, okay? And clients turn to members and candidates for advice, and expert advisors to have more information and knowledge. Yes, you are the expert. If you're a top financial modeler, you're an expert. In fact, for those CFA members in the house, the standards, there was a new standard released last year. Let me show you the new standard released last year. So if you follow these standards very well, in 2024, the standard 1E, if I remember right, that was released. Let me go down to the standard 1E. So this competence is a new standard, right? Professionalism. So those CFA chart holders in the house, you have knowledge. Professionalism had knowledge of the law. You have independence and objectivity, misrepresentation, misconduct. Competence is a new standard. So standard 1E requires members and candidates to act with and maintain appropriate knowledge, skill, and diligence when they carry out their professional responsibilities, so that they provide a high standard of professional service for their clients and employers. So this standard was released in 2024, January, I think, for last year. Yeah. So the Code of Ethics requires members and candidates to act with integrity, competence, and diligence, and to maintain and improve their professional competence and strive to improve the competence of other investment professionals. All right. Okay. Given the diverse range of professional, this is okay. Given the diverse range of professional services, let me make this all bigger. Members and candidates engage in all sorts, the knowledge, skill, and abilities necessary to successfully fulfill their roles will vary according to the nature of their professional duties. Okay, that's fine. They're just telling you that it's not one specific competence you should have. But guess what? If you have given financial advice, your financial advice needs to be based on numbers, right? On forecasts. Nearly everything we do will be based on forecasts. So that is important. We understand there's a professional expertise, there's professional independence required, right? For you to be able to communicate, for you to be able to advise your clients, right? So to me, modeling is, I don't know whether they wrote this for modeling, but if you go and read 1E yourself, you start seeing that, look, CFA now expects it's not ethical for you not to have the skill and then you're advising people. I see some people that say they're financial advisors, but they don't know financials. They can't really read the financial statements as well. They don't know the nitty-gritty of the notes to their accounts or know how to interpret those notes to their accounts. And you need those skills as a modeler to be able to interpret the notes to the accounts, know what the auditors have done, know what drives your financial statements, know what drives each line item of your financial statement, so you can build predictive models. Because the whole idea of modeling is that we need to forecast the future in a way that is kind of, how do I call it, not reality, it's not always right, but it's close to being right. It makes sense, right? What drives this line item? Oh, what drives depreciation? If you're saying depreciation is driven by, how do I call it? Say depreciation is driven by salary expense. It doesn't make sense. Why doesn't it make sense? Because depreciation technically should be driven by the assets you're buying, right? You bought an asset, you're going to depreciate it. Why did you buy an asset? Okay, we a manufacturer, we need to increase capacity. So that means the asset is tied to capacity in a way. Capacity is tied to the actual thing you're selling. So that's how it ties to sales eventually. But what's the direct link? Depreciation, asset. So this competence is super important, right? Accounting competence, financial modeling competence. So this is the new law that came out, a new standard, which I think you should read. Back to our models, searching with models. Let's see what next. The output and potential limitations of quantitative models. Yes. So you need to be very transparent that, look, there are limitations when it comes to a model. Be very transparent. In fact, that takes us to number 3. Let's go to the third one is that transparency, right? That transparency is super important. So let me come here, paste, and delete. And here I'm going to basically say you need transparency, and proper documentation. Yeah. So this is something that you should look at when you build your models. Proper documentation and transparency. So you need to disclose where are your sources, what are the limitations of your model, what have you used to kind of reduce the risk. So what have you used in sensitivity, scenario analysis? What exactly is the model purpose? Who owns the model? Who is the modeler? Yes, what is the audit trail of the model? Do you have an audit section of the model that tells you whether there are errors in the model or no errors in the model? What's version control? Those are things you must have in a model. If you don't have in the model, it's not, you're kind of missing those ethical standards. So let's type that. So you need to tell us your sources, disclose sources, right? You need to disclose sources, models, limitations, right? Kind of the scenarios and sensitivities, the key sensitivities of the model, right? And okay, what is the model's purpose? I'll just say the model's purpose, right? Because models are meant for all sorts of things, right? And then you need to also have an audit trail and audit trail. You need to have an audit trail. What else do we need? Yeah, and version control. Audit trail and version control. So let me show you a model with these things there. If you don't have these things there, I don't think your model has that integrity that you're looking at. Right? You have to have those things. So I go to my guide sheet. So typically, if I go to the guide sheet, you will see that there is an audit tool. Can you look at this? This is an audit tool. This audit tool section is extremely important. As you build your model, You need to be able to audit it. You need to be able to catch errors. There's some basic errors. The most basic one is, look, your balance sheet must balance, right? So if I come here and delete these two things, for example, press delete. Yep. Now, I don't know if you notice something red at the top left. Audit check, error, right? If I come down here, I should see some more reds or something, error, right? If I go to my guide sheet, I should see it's shouting out, forecast balance sheet check. So that means I should go to my balance sheet. There are two forecast balance sheet errors. So if I come to my balance sheet, you see there are two forecast balance sheet errors. Okay, what about my historical balance sheet? Let me delete this one. Delete. Now my historical balance sheet doesn't balance too, right? I should go to my guide sheet and say, okay, forecast, I don't see historical. So you see, even this one, I need to have put historical balance sheet check. Okay, there's no historical balance sheet check there. So this is historical balance sheet, or is it? Is it the forecast balance sheet? Yes, it is the forecast balance sheet. So there needs to be a check for that as well, right? And my restructured balance sheet, there needs to be a check. So if I go to my historicals, okay, let me kind of mess it up from here. If I mess it up from here, let's see if it triggers it. Does it trigger another error? No. So you see, base historical balance sheet check. This didn't trigger. So what is this? It's checking historicals. Let's audit this model. Huh? Oops, sorry. Let's audit this. Why didn't it trigger? So look at your check. Where is the check? I did a search for the check and I check my check. I check my check and see it's checking this too. Now, if I come here and click on this, what is this checking? It's checking rounding something. What's the rounding? Okay, it's checking the top here, this historical values. Well, this historical values didn't flow through, right? So this is the statement of financial position that it's checking. So obviously, there needs to be a tie. So you can see just from my small audit, I can say that this guide sheet has some work to do, but it found the forecast balance sheet check. So what we're saying is, in your model, you need to have an audit trail. There needs to be an audit trail. Let's see some spelling errors here. There's an audit trail that you need to have. You need to be transparent. You need to document. And when you build models, they need to be self-documenting. I can do a Control P for this model, right? That every single sheet is self-documenting. I can do a full print of the entire model workbook, and every single page is documented. See, it's a 40-page model. So your model should be printable. One very important thing, your model should be printable. And look at it. Every page is printable. It's perfectly aligned. So I can print this whole document and bind it as a document and give it to my manager and say, hey, this is the 40-page model. Because some people want to see it on paper, right? Not just on the spreadsheet. So your model should be printable. You could do self-documentation. And how do you do self-documentation? Look at it as I'm documenting, I'm explaining what each section is, audit section. This is saying that this section contains a summary of all audit checks in the model, right? Good documentation. But one other important thing, let me just add that before moving on, is you need to understand if your model is transparent, you've documented, you also need professional independence. One important thing, you need professional independence. So if you are the expert, if you claim to be the expert and then somebody is influencing you, how can you do your job? So you need professional independence, right? You need professional independence, right? So you need to resist pressure. There's so much pressure. Your client will say, my weighted average cost of capital, I don't think it is 17.5%. It's probably around 16%. When you say 16%, that's going to immediately change your valuation by a significant amount. You should base your assumptions on real things. So resist the pressure to adjust your numbers without any basis. Yes? And then if there are major conflicts, and let's assume you are the junior analyst and you have a boss, you need to document and say, this is the situation I have right now with them. There's a lot of pressure for me to update our numbers, especially after this new announcement by this company. And we're thinking that those announcements will generally not affect our projections going forward for the next 5 years, which means our valuation is fine. But we're having also these pressures to adjust our numbers. Please, can you address it, right? So escalate these ethical conflicts. You escalate it to higher ups, right? So because at the end of the day, if you change those numbers, they are happy, well, guess what? Your integrity is at risk. Your integrity as a professional is at risk. So professional independence, we're saying resist pressures to adjust numbers. Very important. Yes, resist pressures to adjust numbers. And what else did I say? Yeah, escalate any conflict to hires up. Escalate any conflicts. So just escalate any conflicts to more senior colleagues, senior members, or just escalate any conflict. Escalate any conflict to whoever, and then most importantly, understand that integrity beats short-term gains. Yeah, integrity beats short-term gains. Very important. So you need to maintain that professional independence when you're your models, in your assumptions, and stuff like that. All right. Let's go back to the CFA Institute. We just typed models. We're number 14. Let's go on. We have quantitative research and techniques. Standard 5A applies to quantitative-oriented research models. Oh, that's interesting. So it's going to have a lot. And processes such as backtesting investment strategies, computer-generated modeling, screening and ranking of investment securities, the creation of the evaluation of derivative instruments, and quantitative portfolio construction techniques. Members and candidates must understand the parameters used in models and quantitative research that are incorporated into their investment recommendations, obviously, right? More members must understand the parameters. All of this is basically talking about your professional independence covers it, isn't it? You need to understand, you need to know how to build models. You need to understand what these numbers mean. When you change this, what happens? You need to know that. So again, you do that under documentation, which the documentation needs to be transparent. You do that under not misrepresenting, no misrepresentation, which I've already talked about, right? And then you do that under reasonable basis. So this covers everything we've said so far, right? Then let's move on. So this is nice. Models, although they are not required to become experts in every technical aspect of the models, they must understand the assumptions and limitations inherent in any model. This is super important, and how the results are used in decision making. So you can't have your manager go to present your model and he has no idea about your model. That's absolutely unethical, which is why you, the analyst, probably need to attend those meetings, right? Because you can't communicate well. You can't communicate effectively if you don't understand the model. Yeah? Okay. Let me see. Is there anybody asking questions? Let me just go to questions and see if there are any questions. Hello, thanks for the invite. Unfortunately, I was at work. Okay. What questions do I have? Let me see. If you have questions, please go ahead and type them into Instagram, Facebook, YouTube, or LinkedIn. LinkedIn is the preferred. Go to LinkedIn and type those questions in. Let me see if I can answer them. So bring them up. Any questions? Let's continue our analysis. So I like this quantitative research and techniques section. It has quite a bit. Again, as everybody, you could go to Google Code of Ethics for CFA, go and download this handbook and do the same thing yourself. And as I said, it's really interesting to download it, give it to AI and tell AI, hey, go through this whole handbook and give me detailed analysis. Give me detailed analysis or give me a detailed summary of ethical issues around financial modeling, right? It would be nice to get AI to do that. Tell me which AI I should use. Should I use Gemini, Claude, ChatGPT? I'll do that later. Let me use Gemini. Let me go to Gemini. Let me put up Gemini. I'll bring up Gemini. I'm going to use Gemini later. So what I'll do is I'm going to download the standards. I'm going to upload it here and then ask Gemini to do that research because this is quite interesting. I think it will be nice. Let me do Control S. Oops. Control S. Save this on my desktop or something. All right. Save on my desktop. And then I'm going to ask Gemini to, I don't know if you saved it. Is it saved? Okay. So upload, desktop, Gemini, standards. I think that's it. Okay. So we're gonna do a prompt for Gemini later, but not now. Let's finish. So it's gonna be interesting to get Gemini to answer this whole question that we're doing, right? So although they are not required to become experts, okay, so we're talking about quantitative methods. They're saying you're not required to become experts, but guess what? Their new standard 1E, says what? You need competence, right? Competence, that's the new standard that the CFA released last year, which is standard 1E, competence. I think I'm surprised they didn't have this standard before. So you need to be competent. How do you become competent as a modeler? Well, let's hear from some newly minted modelers. So I'll just play one or two newly minted modelers and what they're doing currently with their models. Over to our studio team, just pick somebody. Let's understand what modeling expertise means, right? Before we come back.
I am Olamide Goriofe. I work with Kairos Capital as a corporate finance analyst, and coming into this financial modeling academy was because of my love for numbers, and in my role, I need to build financial model. I've been doing financial modeling for about 3 years now, from 2020, the COVID year, and when I saw the advert for the financial modeling academy, it was really a good one for me. Although I was not even prepared for it, but getting to see the huge discount and the value, it's made me opt in for the training and the academy. And getting into the academy was a huge one for me. I've been in doing 1 or 2 things with Dee Brown before. I was part of the bootcamp participant before, but the training in the academy was on another level for me because of the structure and the way the modules were being structured, and the way the tutor with Dee Brown took us in the course. One other thing that stand out for me was the mock exam, because it really took me off gear for me, because my plan of the exam, I've not done the exam before, but getting to do the mock exam showed me my real self, that I'm not prepared. And another thing that stood out for me is the case-by-case, step-by-step guide in answering the exam. That stood all out for me, because for me, I already have issues with the revolving debt schedule before coming into the academy, but getting to see the step-by-step guide in answering the exam really helped me. And also the case study questions, like we have about 6 to 7 that we had to do, and I had to practice them for the exam. That really made the exam a breeze for me when I did it. Thank you.
Okay, so you can see here he was talking about exam. Okay, typically when it comes to competence, right, you need to be competent. And now there is the difference between being competent on your own, being able to build models, everything, you're competent, and then others kind of having proof of your competence. Like I say, hey, I don't know how many of you go into an interview, right? And they say, oh, rate your Excel skills. And you're like, oh, my Excel skills are 10/10. Some say, oh, can you build models, financial models? Can you do budgeting? Oh, yeah, I can do budget. I'm excellent in it. That is your own thought of yourself. So you need an independent person or an independent institution to assess your competence. That is what the Financial Modeling Institute, that's what they do. Financial Modeling Institute is an independent body that gives you exams. You do an exam, you go through an advanced financial modeler exam where they give you assumptions and you build a detailed financial model in 4 hours, less than 4 hours. So they give you historicals, you open your Excel, they're recording your screen, they're recording your face, and AI is also proctoring you, and you need to build your model in 4 hours and submit that model. And a modeler that the Financial Modeling Institute gets, their examiners are modelers, they will go through your model and assess whether you have passed, whether you meet the requirements to get this designation called Advanced Financial Modeler. And that is what the ethics standards in CFA are saying about competence, right? This kind of proves your competence in a certain field. And to me, financial modeling is absolutely critical for anybody in finance. I don't believe that there's no one in finance that doesn't need financial modeling. It's finance, financial modeling. Accounting is financial, so you also need financial modeling, right? So you could enroll for the exams. I click on enroll. The exams are coming up. The exam cost is $725. I'll give you some insights on how you can get an extremely excellent deal if you're a resident in Africa, and even if you're a resident outside Africa. So you do the exams. The exams are coming up in 2 weeks, I think, the next one. And for those, our alumni, for those registered with us as the Financial Modeling Academy, you need to do your mock tomorrow, I think. Or is it tomorrow? I think it's tomorrow. So yeah, but anyway, let's get back. So this is the competence piece, which is super important. Let's get back to the standards. So, we're looking at models. So let's continue going. Quantitative research is key. Members and candidates must make reasonable efforts to test the output of the investment model. So you need to test the output. I like that. So you need to test the output of the investment model. Okay. Yeah. And if you're testing the output, you're doing some reconciliation. You not just testing the output, you're also testing the input. So you're testing the forecast, or should I say ratios. So you're looking at the ratios and saying, okay, this ratio, return on equity is going up. We're planning the historical ratio and going forward. You're testing those things. So look at what is happening. And such validation must occur between incorporating the process into their methods, models, and analysis. Yes, okay, that's good. Individuals who create new quantitative models and services must exhibit a high level of diligence in reviewing new products than that of individuals who ultimately use the analytical output. So the guys building the model need a deeper understanding of what's going on. Yeah, you need a deeper understanding of what's going on, which means you need to understand the business at a far higher level than your typical finance person. So a financial modeler needs to have that knowledge. Yeah. Yes. So that's very important. So you need to go deep. That's what they're saying. You need to involve in developing oversight of quantitative-oriented models, methods, and algorithms must understand the technical aspects of the product. A thorough testing of the model and resulting analysis must be completed prior to product distribution. For me, all of these are financial models. Let me diverge a little bit. Let me give you a list of, or should I say, types of models. So I don't know if one of you have watched some of our older webinars where we did a detailed understanding of the types of models. In that webinar, we broke down models into these categories. We said we have corporate finance and core valuation models. We have FP&A planning and operational models. FP&A is financial planning and analysis. Planning and operational models, sector and business model specific models. We have risk and analytics models. We have transaction and restructuring models. We have tax, equity, and ownership models. We have performance and value creation models. These are the definitions of each. Type in the chat which one you want me to expand on. I can't expand on all. We don't have much time. If you want deep explanation, you can go to the previous, you can go to D. Brown Consulting, go check all our historical, the webinars we've done. We did a webinar on modeling types of financial models or something. So type in the chat which you want me to expand and give you more details, just one. I will take the very first thing someone types. I'll expand on it. The very first thing someone types in the chat. So let's get back to documenting our standard. We're creating like a standard for modeling with integrity, ethical standards for finance professionals. All right. we're creating our own standards, right? So professional independence, we did one. Which other standard do we have? Let me see. So my thought process is going to communication. So we need exceptional communication skills, right? So if you don't give clear communication, or should I say balanced communication, yeah. So when we say balanced communication, when you're building a model, especially a financial model, a three-statement model, you're going to get financials from audited financials of the company, right? Those audited financials follow rules. So the accountants, they're very good at following rules. They're rule-based people. So they follow rules from IFRS. So you have IFRS, which is the International Financial Reporting Standards. For the US, people in the US, they use US GAAP, yeah, generally accepted accounting principles or something like that, yeah. So those standards, obviously, you're getting numbers from those standards, but you're restructuring those financials. So you need to be very transparent and communicate. This is IFRS, this is the financials, this is how I restructured those financials. And be very, very, very transparent in that communication of what you're doing. These are the metrics in those standards. This is how we've restructured it. So your return on equity, or your current asset ratio, your current assets, actually we pulled certain things out of this current assets, we put it here. Why did we do that? Explain why you did that. Do you get? So you need to then kind of explain the reconciliation differences you have, and that's it. So it's just communication. So here I will say label in detail your restructuring assumptions from IFRS / GAAP to generating your drivers, right? To generating your modeling drivers. All right. So this is important. Let me go to a model and show you what I mean. And in this model, right, you can see we have restructured. What does that mean? If I go to my historical financials, these are the financials from the audited accounts, right? If I make this bigger, this is what your auditors gave you, right? Came in from the audited accounts, your profit or loss, your balance sheet. This is from your audited accounts. 5-year financial trend from your audited accounts. This will lead to ratios from your audited accounts, right? But then you need to restructure them. Why? I wrote it here. This section contains full details of the restructuring exercise on the historical balance sheet and profit or loss, with reference to the notes to the accounts to normalize the financials for more effective forecasting and valuation. So we're normalizing the financials by removing things that are non-recurring, by splitting things out. So look at this, see cost of sales. What was split out of cost of sales? So in this restructuring, they pulled out depreciation away from cost of sales. So depreciation on plant and machinery, that is driven by plant and machinery, right? So as plant and machinery grows, your depreciation grows, and depending on the accounting policy, how are we depreciating? Is it 5 years, 3 years, or whatever it is, right? Impairment losses are driven by something else, probably one-off stuff, right? So if you have to remove these things from cost of sales, because cost of sales is driven by sales. Depreciation is driven by something else, which is assets. So that is the process you go through. So you have your cost of sales based on audit, IFRS or GAAP, and your cost of sales based on drivers, your model. So once you restructure, that is the restructured financials is what you then put into your, this is PL restated, restructured PL. Very important. Once you've restructured your financials, it doesn't mean you've changed your financials. The profit at the end, this profit must be the same. Your profit after tax is the same as your audited. If it's not the same, that should throw up an error, right? Let me go to our guide sheet and see if it threw up an error. Yes, it did. So your restructured income statement has an error, right? But all of this you're going to learn in the academy. I'll give you details about the academy shortly. You will learn all of this in the academy, all right? I've really messed up this model, and it has auto-save. I'm in trouble. Why did I do that? Let's do Control Z, undo. Oops, now I'm going to undo this. Not gonna work. Okay, you see, you have to be careful. Well, in Excel, you can go back to a version, right? You can go to an older version. I'll clean this up later. All right, let's get back to our analysis. So we went to how are we building up ethical standards? We're borrowing from the CFA Institute's body of knowledge under their standard practice handbook. And then I typed the synonym for financial modeling, models, and I could see the entries, and I'm going through the entries to see what CFA has to say about modeling or forecasting in their standard. And we're using that to create our own standard for ethics and integrity in financial modeling. We're creating our own mini standard, yeah, which we're almost done. So that's the process, right? I'm showing the whole process of how I think through these things, right? Anyway, let's move on. Where are we? This one says model. So in reviewing computer models, is it computer models, or the resulting outputs, yeah, computer models, members and candidates must include factors and assumptions that are likely to have a substantial influence on investment values to ensure that the model incorporates a wide range of possible input expectations, including negative market events. I think we've covered this under misrepresentation, under professional independence, but yeah, I think we've covered this. We've covered this in our own mini standards. That's fine. Let's move on. Members and candidates must also consider the source of and time horizon of the data used as inputs in financial models. Yeah, definitely. Time horizon is extremely important. I have shown this before in our project finance modeling course. Time horizon is, I think, the most important thing when it comes to project finance modeling. And I'm sure some of you have seen this example that I've shared before, where when you're building a project finance model, and the model is the cost of the project is funded by the cash flows from that project. So if you look at, you typically have timings, right? So you have month in the year, 12 months in the year, that's the timing. All these things at the top is your timing. This is a very important field in your model. So when does something happen? When doesn't it happen? If that thing doesn't happen at that time, what are the financial implications, right? So you have months in the period, 1 month. This is a monthly model. Model start date. This is when your model is starting. You put any date there. Then it says starts of construction. How many months after financial close? So there's something called financial close. You've already agreed with the bankers or the funders of this project. We're funding it to $1 billion of funding. Once you've done financial close, it means you can start drawing down on your money, isn't it? So what is start of construction? Construction is starting 5 months after you get your money from the bank. Or you can change this to 2 months, right? The moment you change this to 2, the entire model should update, and any dependencies should update as well. That's the beauty of modeling. So you see, I changed this to 2, you saw some things change. So by changing this to 2 months, which means we're constructing faster, we save 3 months of construction, which means that your operations are going to start 3 months earlier, which means that you're going to start getting money back faster, which means that your project should be worth more. Everything is tied. Now, a modeler should be able to model these things transparently, perfectly, right? And review for it to be ethical and for you to have integrity in your model. So all these timings lead to massive timing schedules. Anything you see red means it hasn't started. Anything you see green has started. So here you say construction has started here. And this is your construction period, right? How long does construction take? This, and then this is a button that shows construction has ended. And then this one says, what's this one? This is post-construction delay period. Oh, your construction was supposed to end here, but then there was some delays, right? And because of these delays of 2 months, everything, so let's test this. So look at this. This is February 2028, where delay started. Let's go and make the delay worse, huh? Let's make it worse. Let's go up. Where's delay? Where's our input for delay? Let's see. Delay in start of operations. Can you see? 2 months. Let's say it's 5 months. Terrible. 5 months. That means construction didn't end when it's supposed to end. It extended. So let's look at the delay. Let's go and look at that delay. See, we extended from 2 months to 5 months. Now let's see if that is modeled. Can you see it is? So your construction was supposed to end here, but it extended for 5 months, which means every other thing has shifted forward, which is terrible. But meanwhile, your debt is still running, isn't it? Right? So once you do all of this and then you tie this timing to your calculations and they're all perfectly timed, perfectly modeled, then as CFA, the standards are saying members and candidates must consider the source and time horizon of the data used as inputs for your financial models. Super important. So I think this is part of documentation. And one important thing here is you need somebody in your team to validate these things. So one last standard I'm going to add here is governance, right? Governance and validation. So governance and validation. So to me, this is key. What am I saying here? There needs to be some form of how do you govern this financial model that we're building, the process for people reviewing, the process for validating your numbers, that there needs to be a system at play, right? So independent review of your assumptions, continuous model monitoring, and sometimes on a monthly basis, if that model I just showed you is an operational model. As you're constructing the project, as you're paying your debt, every month is being monitored and being validated, right? So, yeah, so that's it. So independent, you need independent review of assumptions, continuous, my spelling is terrible. Continuous, I think it's correct. Yeah. Continuous model monitoring and validation, right? Independent review of assumptions, continuous model monitoring and validation of drivers. Yeah. Independent review of it. Yeah. So that's it. So governance and validation. So technically, this is the summary, right? You have reasonable basis. You need to have no missing representations, transparency and documentation. You need professional independence. You need balanced communication, and you need governance and validation. So this is your modeling with integrity, ethical standards, and for finance professionals. Now, let's ask AI to do this as well, all right? So fun part, let's ask AI. But let's finish this model thing. 23, next. Let's go next. Next. Develop detailed written guidance. Oh, nice. See, guidance that establish minimal levels of scenario testing of all computer-based models. Good. So you need minimum guidance, scenario testing. So you need lots of scenarios. Very true. You can't. I think that's under reasonable basis, right? Let's check. Ground every projection in verifiable data. Sound logic, not count logic. Sound logic and transparent assumptions. Now I have to also add transparent and multiple assumptions with multiple scenarios. With multiple scenarios. Right? Let's go back. Right. Computer-based models used in developing rating and evaluation financial instruments. So look at this, used in developing and rating and evaluating financial instruments. Let me show you a model I built recently for a client, for a compliance model. So compliance model I built, where it's not financial model, but it affects financials. So this compliance model is quite interesting. I really like the project. I'm just going to show you a mock-up of it. It's not the real thing. So look at this model. Yeah. So this is a model. There are inputs, there are calculations, and there are outputs, right? So what did we do? We basically typing out things. We said, okay, what country are you in? If I type a country like United States of America, can you see they say low risk? Now, where am I getting this low risk, high risk from? I do a country risk analysis. I go to a database of Transparency International Corruption Perception Index 2023, and then I update this perception index based on the countries, all the countries they list, and what is high risk, what is low risk. And I create my own rating scale that says, okay, DBC rating scale takes the position of ranking the AML country risk rating as thus. If you get a 0 to 50% score on Transparency International, I will rank it as high risk. If it's 51 to 69 as the ranking is medium risk, 70 to 100 low risk, all right? So this is from Transparency International, and then I list out all the countries and I give them a risk rating, right? So if I come to my model, the output of my model is an automated model. It's a tool that was built. So I type the name of the company, right? And then I say, okay, which jurisdiction is it? What corporate status is it? Parent? Is it the parent? Is it the subsidiary? It's a subsidiary. What's the date of incorporation? How old is the company? Is it listed or not listed? If I say, is it listed? These are all different. This computes different things based on my selection. And then all of these line items, it will calculate whether they are low risk or high risk, or low risk or high risk. And then you eventually get a risk score at the end, right? You have a risk score at the end. And say, oh, the risk score is 22.21, high risk, big risk, and stuff. So this is a tool. So modeling is vast. And let me see if you've answered my question as to which types of modeling you want me to expand on. Let me see. Have you answered? Where's my comments? What do you want? Financial model and valuation. Let's see. FP&A. Okay, FP&A. NA says FP&A. Is NA? Okay, no, somebody said before you. NA Sunday says tax equity and let me see. Is that the first entry? Tax equity. Yeah, I think that's the first one. All right, so let's go to types of financial models, and we're going to go into tax equity, where we tax. So you wanted to expand on this. It's quite a small one. Tax equity and ownership, right? So we're saying these types of models are allocation and management of financial interests and obligations among stakeholders in a project or company. So the stakeholders in a project or company we're trying to understand. So this is typically for project finance. Why do we have tax here? Tax. So tax basically is the government. Sometimes big project finance projects, the government is the stakeholder. So tax is a key thing. Equity for those taking equity risk, debt for those taking debt risk, and then you have the ownership. What's the ownership structure? So here are the kind of models. You have your tax model, book tax bridges and valuation allowances. You have your ESOPs. These are for your share-based compensation, right? So check ESOPs, they build models around that. Your cap table, this is for venture capital, cap table and dilution. So what are your various funding rounds? Do you have safe notes or notes? Do you have options? Do you have conversion? Do you have pro forma ownership? All of this have very interesting implications for your models, right? So those are models under tax, equity, and ownership, right? Depending on if you have private equity or your venture capital, you'll be interested in these kinds of models. So all in all here is about 60 types of models. If I go to the very first thing you see is three statement models. You need to master this. Then you know DCFs and stuff. These are your standard models. Standard models. But modeling is such a huge field. You need to know quite a bit. But if you don't know these fundamentals, you can't learn this. This other stuff can be learned by you, but you need to know the foundations. And I see in my almost 30 years of building models, people don't get that foundation well. And they keep building on a shaky foundation. Kind of risky, isn't it? Right? All right, let's finalize our CFA analysis. I go next. Examples, use of quantitative-oriented models. These are examples. CFA usually have examples, so they're trying to explain the standard or the ethics by giving examples. I'm going to skip the examples. It's also an example, another example, 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 example. So we've covered the big bases. The rest are just examples, which are nice. You could go read them. These are examples further explaining what it is we saw. And once we've covered this, that means we've covered everything the CFA standards, the ethical standards have to say about forecasting and modeling. And we've used that to generate our own set of standards: reasonable basis, no misrepresentation, transparency and documentation, professional independence, balanced communication, governance, and validation. Now, let's see what AI brings and see if it's close to what we just did. AI, which AI are we using? I think we agreed to use Gemini, right? Yes. So what prompt am I going to give? Hi, I would like you to use, okay, I'd like you to create a set of financial modeling, forecasting, ethical, and integrity standards based standards using similar entries from the attached CFA standards and ethics document, right? Document, yeah. All right, so I just tell it to be succinct. please be succinct and give a short summary of these standards in a single page. All right. You may add other context from other sources, but please name all your sources. All right. So this is my prompt. Let's have a look at what it does, right? I don't need to change the spelling. It knows all my spelling errors, so it should be fine. Now let me do a Control A, Control C. Why? Who knows? My internet may mess up and I will lose this. I don't want to lose it. All right, let's see what it does. It's thinking. This is Gemini, so you could do the same thing for ChatGPT, Claude, and all those other AI frontier models. But this guy is analyzing a lot. Let's see. Let me get back to our slides. So we'll come back to it once it finishes the analysis. Let me jump back to our slides. Right. So what do you need to basically run an academy? So this academy, we're almost done. We have only 10 minutes left. So we at D Brown Consulting, we run a really wonderful academy. So would you like me to help you become a world-class financial modeler so you can harness your skills to earn more and become a top talent? Because there's one thing to earn, there's another thing to learn. So you need to learn before you earn, and you have to learn and build that competency. Once you build that competency, you need somebody to validate that you have that competency. That's the Financial Modeling Institute, right? Financial Modeling Institute will validate that you have the competency, you get your international accreditation, and you start earning. And all of this is inside the Financial Modeling Academy. Special academy we have. Absolutely exceptional academy that we have. I wish I had this 30 years back when I started my career, right? So yeah, you get a world-class financial modeling training, and you take an internationally respected accreditation exam from the Financial Modeling Institute. I've shown you the exam already. It is the Advanced Financial Modeler Certification, right? So you get that. So this is the only cohort-based training and coaching program of its kind that uses a curated step-by-step methodology, building a real-world financial model from scratch, then grooms you to take an online proctored global recognized accreditation exam to earn the Advanced Financial Modeler designation. So I'll give you a short time to kind of listen to Ian talking about this. Ian is the director of the Financial Modeling Institute, and he'll just give us a brief talk on this so you can see how you can benefit from this. Right? So let's listen to Ian. Okay, some small traffic for Ian. I don't know. We can listen to Ian now, hopefully. Okay, let's listen to Ian announcing the academy. Not sure if you can hear Ian.
Hi, I'm David Brown from D Brown Consulting.
And hi there, I'm Ian Schnur from the Financial Modeling Institute, the FMI, in Toronto, Canada. We are very pleased to announce the launch of the Financial Modeling Academy, the FMA.
And the launch of a special scholarship for African residents and students. The FMA will open up employment opportunities as analysts in private equity, hedge funds, FP&A.
Thousands will be able to get employed as corporate or commercial bankers, work in private debt or equity research, and become a valued strategic advisor to any organization in the world.
And the Financial Modeling Academy takes just 8 weeks to complete at a fraction of the cost.
Click the link below or scan the QR code to join the next cohort of the Financial Modeling Academy today and supercharge your career in finance.
Great. So that was Ian, the the executive director of the Financial Modeling Institute, talking about the Financial Modeling Academy. It's a really massive program. It's me and some other people talking about their experiences. Oliver is a student in University of Lagos, still level 3 in accounting. It has opened the doors. He's already earning money while still in university. After getting the designation, he's building small models for companies all over the world. We have Evelyn here. She said, why not give it a try? And today she has no regrets, right? And we have a senior financial analyst who can now build and structure complex models. Before I enrolled, building a model was like a black box, right? So these are people. Now, what do you get? So the whole process, the whole program is worth about $2,871, right? The FMA course, where I'll teach you how to become a really good modeler, building solid 3-statement models like the ones you saw from scratch, confidence in building a model for any company, financial model. Then we will hand you over to the Financial Modeling Institute, who are partners, and they'll do the exam. You'll do the exam with them. The exam alone is worth $725. The course, our D. Brown Core Fundamental course, which we developed over 20 years, is $1,200. That's the current worth of the course. Then you do an exam prep. We'll prep you for the exam. Very detailed prep, step-by-step prep for the exam. It's $199. We sell that commercially. Then you do an Excel primer. Even before joining the program, you do a primer in Excel. We'll polish your Excel skills up. We even polish your basic modeling and accounting skills up, right? Modeling primer. As part of the program, you're going to join 2 communities. One North America-based, which is run by Financial Modeling Institute, and our own community, which is kind of Africa-based. So you have 2 communities that you're going to learn from and learn from your peers that have done this, right? And then as part of the 8-week core program where I'm teaching you financial modeling, every weekend, I'll be mentoring you, answering your questions every weekend for 8 weeks, right? So you'll get content on a cohort basis every week. You get content every week, which is supposed to finish. You're also going to have study groups. You need to have study groups, accountability partners that you work together to ensure you hold yourself accountable to finish the content. If you follow the process, it's almost guaranteed. Nothing is fully guaranteed, but it's almost guaranteed that you'll pass if you follow the process well, right? So everything, $2,871, that's what it's worth. What do you get? How do you get it? What do you get it for? Well, you get it for only $150 if you're a student. But students only, you need to be pre-registered with us. Not easy to get it. We have to sign up some universities with us first for you to get it, or sign up some professional bodies where you're a student of that professional body. But the key thing you'll get is the $347. So the whole $2,871, you're getting it for $347. The exam alone is $725. We're getting the whole thing. If you are a resident in Africa, if you can prove that you live in Africa, any country in Africa, you get it for $347, right? This whole $2,871, you get it for $347, right? So you must be resident in Africa, right? If you're a resident in South Africa, unfortunately, you don't get it, but you get the global one, which is the non-African resident. You still get the scholarship, $972. It's still excellent compared to $2,871, right? $972 for South Africa and everybody else in the world, right? African residents, $347. The next cohort is coming soon, so you need to register quick. But if you're a student, and students, if you are not a student and you register, you're not getting, you're going to be kicked out, and you're getting a refund. So this 150 is especially for students, undergrad students. Undergrad students, like you saw one of the students in University of Lagos, he is already earning with his designation, and he's still a student. He's still doing level 3. He's level 3 of accounting. He's accounting undergrad, right? We also have this for students of professional bodies that have signed with us. ACCA has signed with us, or CIMA, well, not CIMA yet, but CFA Institute. If you're based in Nigeria, ICANN. We're currently working with ANAN. We're currently signing with Chartered Institute of Stockbrokers, Chartered Institute of Taxation. So if you're a professional body, verifying you, and you're a student of a professional body, the professional body needs to verify you. You can register and everything, you will not do the exam until that professional body comes back to us and says, oh, David is our student. Then you're good to do the exam, right? So that is it. That is the Financial Modeling Institute. That is your content. I hope you enjoyed the webinar, and the webinar topic was, let me just fly back, modeling with integrity, ethical standards for finance professionals. And we ended up coming up with what? Our own set of standards for those ethical standards, right? Now we're going to finalize this with AI. Let's see what AI came up with. This is what we came up with. Modeling with integrity, ethical standards for finance professionals. For modeling, reasonable basis, no misrepresentation, transparency and documentation, professional independence, balanced communication, and governance and validation. What did AI come with? I'm really even keen to see this. Let's see, what did AI come with? Let's see, where is my AI? AI, what did it come with? All right, let's read. Financial modeling and forecasting ethical and integrity standards, a one-page summary. These standards are adapted from professional guidelines to ensure that financial models, forecasts, and analysis are reliable, objective, and transparent, promoting trust among all stakeholders. Integrity and objectivity in modeling. Okay, very nice. Independence and objectivity. They have standard, you have principle for financial modeling, you have the source, CFA. See, it's even putting the source there. 1B and 6A. Wonderful. So independence, so it's writing your sources there. First, integrity and objectivity. A modeler must act with integrity, competence, diligence, respect, and an ethical manner, placing the integrity of the financial markets and interests of stakeholders above all personal interests. That's number one. Number two, diligence and reasonable basis, model and assumption rigor. The modeler must exercise diligence, independence, and thoroughness when creating, testing, and applying any financial model, ensuring a reasonable and adequate basis for all analysis. Very nice. Number three, it says data integrity and governance. It's similar to ours. I'm happy with ours. Integrity shows the accuracy and reliability of the data used with forecasting, which is vital for sound decision making. It tells us where it got it from. Data integrity framework. Okay, got this from somewhere else, right? Okay, interesting. Then communication and disclosure. Transparency is the cornerstone of ethical forecasting. The modeler must provide clear and comprehensive information to allow stakeholders to understand the basis of the forecast. Okay, not bad. Sources cited and stuff. So that's its stuff. I kind of prefer mine. Ours, since we build this together. Reasonable basis, no misrepresentation, transparency and documentation, professional independence, balanced communication, and governance validation. So what I'm going to do is I'm going to take what we just did now. I'm going to give it to AI again. I'm going to tell it to expand on it significantly. And maybe when I have a nice document, that's like our standards, right? I'll work a bit more with AI as we go on. But what did we, how did we come up with this? We went to the CFA ethics standard and we went down the ethics standard and we built it up. So that is your session on modeling with integrity, ethical standards for finance professionals. Now, when you don't do this, you're at risk. You're putting your company at risk. Now, look at this that came out just a couple of days ago, right? Deloitte to partially refund Australian government for reports with apparent AI-generated errors. So this is a report that there wasn't, I mean, it of course uses lots of numbers, lots of models. There wasn't a professional independent review as thorough. There wasn't a thorough review. Transparency and documentation, AI did some things, but AI hallucinated. So there was a lot of misrepresentation, right? And there wasn't any reasonable basis for some of the assumptions they gave. And that is because of a failure of governance, right? And there wasn't balance. In fact, they failed everything here, right? With this. You can go check it out. And if you read about it, it says Melbourne, Australia, Deloitte Australia will partially refund the 440,000 Australian dollars, $209,000 US dollars paid to the Australian government for a report that was littered with apparent AI-generated errors, including fabricated quotes from a federal court judgment and reference to non-existent academic papers. So, yeah, that is a lot, isn't it? We don't want that. So let's stick to these standards and ensure our models are built with integrity and we uphold ethical standards. Thank you very much, everybody. I look forward to seeing you in the next academy and look forward to our next webinar. I want to say thanks a lot to the D Brown team at the back end for making this happen. Looking forward to seeing you again. All right. Bye-bye, guys. See you.
Hello, I'm David Brown. I'm here to talk to you about the Financial Modeling Academy Scholarship for Africa. We're so proud to bring this to you in partnership with Financial Modeling Institute. This completely crashes the price of the wonderful Financial Modeling Academy, where you're going to learn all the different things in 8 weeks, all the different things about how you build models from scratch, valuation, also understanding how to do the exam, the cost of the exam, the cost of actually the mock exam, the cost of the exam prep guide, the cost of all the past examination reviews, the cost of the program itself, and then the general cost of the community that you're going to join to answer all your questions. All of this at a hugely discounted rate. So click here to see how you can benefit from this wonderful experience, and let's join for the next academy and the next cohort. I'll see you in the next cohort.